Let's talk about stock investing for beginners. Let's say you have $500 to invest, or you might have more. You might have $1,000 or more, or you might have less. You might have $200 or less, but you do want to start investing in the stock market. That's why today I want to talk about how to actually start investing in the stock market. Now, there is a lot of information that I got to go through, such as what is a stock? How does the stock market work? What is the actual benefit of owning a stock? What's the difference between a growth stock or a dividend paying stock? I also call that an income stock. What do you do in a stock market crash? Mutual funds, index funds, ETFs, bonds. These are some of the topics and more that I will cover today in this video. So at the end, you will have a clear picture of what you need to do or how you need to start investing your money in the stock market. So let's get started. When you think about investing, it might seem quite daunting because there's so many different ways that you can invest. But once you finally get into it and you start doing it, a little bit of hands-on experience, it will become easier. So let's start by looking at what a stock actually is. A stock represents ownership in a company. A stock is nothing more than a piece of a company that a shareholder owns. And of course, there are some benefits to owning stocks. One of those benefits is that you have voting rights as a shareholder. So once a year, you can vote on different business practices that happened within the business of the stock that you own. Another benefit of owning stocks is that stocks have the potential to make you really wealthy. So you buy stocks at one price point today, and 1 year, 2 years, 10 years later or more, that asset that you bought in the form of a stock more than likely increased in value. The third benefit of owning stocks is that some stocks, not all of them, but some pay you an income on a frequent basis, also known as a dividend. So think about a stock, which is of course a piece of a company. Think about a stock like this. Let's say there's a family of 3 and they just ordered a pizza. They got the pizza delivered to their home and they ordered a large pizza. This large pizza contains 10 slices. So the son, he only gets 1 slice, which is 1/10 of the pizza or 10% of the pizza. The dad got 2 slices, which is 2/10 of the pizza or 20%. And then the mom just took 1 slice. The rest of the pizza gets put in the fridge. Now the dad who has 2 slices, that's his, like he owns those 2 slices. Same thing with the companies that trade on the stock market. Now these companies are not divvied up into 10 pieces only. They are divvied up into millions, billions, or even trillions of pieces that you and myself, that you and I can buy. So there's a term called shares outstanding, which represents the total amount of pieces, or in this case stocks, of a company that's trading on the stock market. For example, so if you go to Yahoo Finance, you can see that McDonald's has 744 million shares outstanding. Nike has 1.2 billion shares outstanding. And the last example, Apple, they have 17.1 billion shares outstanding. Keep in mind that you're not limited to only buying stocks in your particular location or your particular country. So for example, let's say if you live in the US like myself, that does not mean that you can only buy stocks in US companies. You can buy stocks in companies in Brazil, in Germany, in China. You can buy stocks globally. The next thing I want to talk about is 2 different types of stocks that you need to pay attention to. Growth stocks versus income stocks. A growth stock is a stock that has the potential to increase in value fast. Growth stocks are usually tech companies such as Twitter, Google, Facebook. These companies are very volatile when it comes to the stock market. So yes, they can go up in value fast, but they can also go down in value fast. An income stock is a stock that is a lot more stable. These stocks are usually coming from blue chip companies. So these companies are the market leaders in their market. These companies are companies that sell goods or services that are really stable. These companies and these stocks, they might not increase in value fast, but the benefit of these companies or these stocks is that they pay an income on a quarterly, yearly, or even monthly or bi-yearly basis. Now, there is a way to check and see if a stock is a growth stock versus an income stock. One way that you can check is to look at the beta of a stock. This is not a hard and fast rule because there are exceptions, but the beta of a stock means the volatility of a stock compared to the benchmark. Usually the benchmark that is being used is the S&P 500. The S&P 500 tracks the 500 biggest companies, biggest public companies in the US. The benchmark, the S&P 500, is always going to be 1. So if you look at a stock and you look at the beta, and the beta is above 1, that means that it's more volatile compared to the benchmark. Just take a look at this example. So for example, McDonald's Corporation has a beta of 0.68. Nike has a beta of 0.84, and Apple, which is a tech stock, has a beta of 1.28. So for these two types of different stocks, there are also two types of investors. You have growth investors, investors that focus on growth, and then you have value investors. Those are investors that focus on stocks that produce income. So as a growth investor, those are investors that are risk takers. They like to buy and sell frequently. So buy low, sell high, or even buy high, sell low, which is called short selling. Income investors are value investors that like to own stocks for a long period of time because you buy a stock and while you're holding it, it's producing you income. These stocks are also a lot more stable. These stocks don't need management. You don't need to buy and sell these stocks constantly. You don't constantly have to take a look and see how they are performing. Income stocks are, to a certain extent, buy, hold, set it, and forget it. Now, we talked a lot about stocks, but we did not touch on where you can actually buy these stocks or sell them also. So this is where a stock exchange or a stock market comes into play. Now, when you hear the word market, what do you think about? You think about a place or a location where buyers and sellers come together in order to exchange or trade in goods and services. So, for example, think about a car market. At a car dealership, whenever you want to buy a car, you go to a car dealership. You meet with the seller and you start to exchange and you probably negotiate also to buy whatever car you want at a reasonable price. Same thing with the stock market. Instead of selling cars, at the stock market, you can buy and sell shares of stock. The two biggest stock exchanges in the US are the NASDAQ and the New York Stock Exchange. It's on the NASDAQ that you can buy shares in companies such as Microsoft, Apple, or even Starbucks. And it's on the New York Stock Exchange that you can buy shares in companies such as Walmart, Coca-Cola, Snapchat, Johnson & Johnson. Now, in the past, there were some major differences between the New York Stock Exchange and the NASDAQ. For example, the NASDAQ has always been digital. It's always been electronic. And the New York Stock Exchange was actually a trading floor where buyers and sellers would come together in order to trade in shares of stock. But nowadays, even the New York Stock Exchange has become a lot more digital, especially because of high-frequency trading. Now, another market that you should know about is the OTC market, the over-the-counter market. This is a market where you can look at trading or buying or selling shares in companies that are up and coming. The OTC market can be a lot more sketchy, so definitely do your research before you trade anything over the counter. In the OTC market, that's also where you can buy and sell a lot of penny stocks. Back in the olden days, the stock market was only accessible to the rich and wealthy, also called Wall Street. Now, the people on Wall Street actually learned something. They learned that if they can bring Main Street into the stock market, Main Street being regular investors like you and myself, if they can bring Main Street investors into the stock market, they can make more money and potentially we can also make more money. So why is the stock market so volatile? Why does it keep going up and everybody seems happy and then all of a sudden it crashes? And then it goes up again and then it dips again. So one of the reasons why, and if you look at the short term, it can be many things. It could be definitely speculation. It could be bad news about the economy. It could be changes in governmental policies. Any news could have an impact, whether good or bad, on the stock market. Now, when you look at an individual company, that's even more interesting because a company that's on the stock market, if any bad news comes out, it's usually going to have an immediate impact on the stock price of that particular company. So for example, let's say it's found out that a fast food company that's trading on the stock market, they were selling old meat or they were selling old food, and it hits the news, people hear about it, they're shocked. It potentially has an immediate impact on the price of the stock and you might see it tumble down. Now, also think about long term. Think about the market cycle that we're in. So in times of economic prosperity, people feel good, people are making money, they have money to invest. So on average, the stock market is going to go up. Now, in times of economic turmoil, in times of war, in times of people losing their jobs at a high rate, that usually also reflects in the stock market. So besides buying stocks on the stock market, there are other additional securities that you can buy, such as commodities, index funds, mutual funds, ETFs, options, futures, and bonds. We'll talk about a couple of them, not all of them because that's a topic for a different day, but let's touch on mutual funds. A mutual fund is a basket of stocks or bonds or a combination of those two that you can invest in. Now, if you're the type of investor that does not want to go out there and start to pick and choose individual stocks that you want to invest in, a mutual fund might be better for you. A mutual fund gives you instant diversification. Now, keep in mind that you will have to pay fees whenever you invest in a mutual fund because a mutual fund is managed by somebody, especially the company that you're buying the mutual fund from. So you will have to pay attention to management fees and any additional fees that are associated with that mutual fund that you're thinking about buying. With bond investing, you're pretty much loaning your money out to a corporation or a governmental institution for a set amount of time. You're gonna get your money back, your principal, with interest. Now, index funds and ETFs are pretty similar. An index fund, whenever you invest in an index fund, you are investing in a fund that is tracking its underlying index. So for example, if you invest in an index fund that tracks the S&P 500, you have automatic diversification because that index fund tracks and keeps up with the 500 companies in the S&P 500. An ETF, similar. The main differences between the two are the fees. The fees are slightly different between the index fund and an ETF. So let's talk about companies on the stock market again. Companies on the stock market are publicly traded companies. These public companies are beholden to their shareholders. This means that they need to document and present how they perform to their shareholders. They do this in different reports. So for example, you have a 10Q, which is a quarterly report, and you have a 10K, which is an annual report that you can look through, read through, and see how the company performed. Now, in order to get to a 10Q or a 10K, it's really easy. And you don't even have to be a shareholder to get access to a 10K. Just go to the company's website or just Google the 10K for a company and you should be able to find it. Buying your first share of stock nowadays is extremely easy. All you need is a brokerage account, and some money deposited in your brokerage account, and you're good to go. So pretty much all you need to do is navigate to a website such as Ally, Robinhood, TD Ameritrade, set up an account, so fill out your personal information. Your personal information will get validated, so that might take a couple of business days. After you've been approved, you just want to connect your checking account and deposit some money into it. You don't even need to deposit that much money. You can start with however much you want, $10, $20, $50, $100, $500, or even more. And then once approved for everything, you're ready to play the stock market game. So I logged into my Robinhood account and I deposited a little over $500 a couple of months ago, and I bought some shares. So what we'll do is let's buy Apple. So I'm just gonna type in AAPL, which is the ticker symbol for Apple. I'm gonna hit buy, and let's do this. So I'm gonna buy shares in Apple. Now I only have $45.60 available, and the market price for Apple right now is $134.15. So I should not be able to buy, right? So let's hit, I want to buy one share. Let's hit review. So not enough buying power. You don't have enough buying power to buy one share of Apple. So this is what we're going to do. Instead of buying one share of Apple, we're going to buy a fraction of a share. So I'm going to switch the option from buy in shares to buy in dollars. And here's the interesting thing. Buy Apple in dollar amounts starting at $1. So for $1, I can start investing in all these different companies. So let me go ahead and click on that. So I want to buy a fraction of Apple for $1. So I'm going to do one. I'm going to hit review. And you can see I'm not going to get a whole share. I'm going to get a fraction of the share. And all I have to do is swipe up and give it a couple of seconds. Done. So I purchased a fraction of the Apple share for only like $1. Also, a couple of seconds later, I got a confirmation that I purchased a fractional share in Apple. Now we just looked at how easy it is to buy your first share or even a fraction of a share. It's so fast, it happened in under 2 minutes. That's how fast you can buy shares. However, I don't recommend you do it this way. Whenever you think about investing, you always need to think about your goal. What do you actually want to achieve? What's your end goal? So if you are a young investor, you are a lot more riskier. So you might just want to jump into the stock market and just try to get your hands dirty, buy some shares, sell some shares, just try to figure out how the stock market works, which is perfectly fine. But if you're a long-term investor and you have a long-term goal, you might want to think about, okay, what investment style works best for me? Do I need to invest in stocks or bonds or both of them? And what's the asset allocation between those two? How long is my investment time frame? Do I want to invest for 1 year, 5 years, 10 years? These are questions that, of course, I cannot answer for you. These are questions that you just need to sit down, write these on a piece of paper, and then based on your answers, that's how you want to approach the stock market. As an investor, you also need to ask yourself how risky you are. If you are younger, of course, you're gonna be able to take a lot more risk because you have time on your side. You can make mistakes, you can play around in the stock market, you can lose a little bit of money and you can gain money, and everything is fine because you can always bounce back. But if you're close to retirement age, things are a little bit different. You want to be a little bit more cautious with what you're investing in. And definitely you want to invest in safe assets that will generate you income for the long term, such as bonds or even dividend paying stocks. There are many different investment accounts on the market. So for example, you have a 401k, those are the most well known, the 401k, the 403b, the Roth IRA, the IRA, which stands for individual retirement account, and a regular brokerage account. So let's talk about the 401k. If you work at a company, it's more than likely that you will have access to invest in a 401k. One of the benefits of investing in a 401k is that whatever amount you're investing into a 401k, your company might potentially match that whatever you're investing in that 401k. Another benefit also of investing in a 401k is that if you're an investor that's not that well versed in investing, the 401k will work for you because the company picks and chooses like different mutual funds, different index funds, or even target date funds that you can invest in. Most likely there won't be any individual stocks that you will invest in unless that particular company that you work for is on the stock market and you can buy shares in the company's stock. The target date fund is actually pretty interesting. So the target date fund has a specific retirement deadline, which is a specific year. So a target date fund might say target date fund and it ends in 2050. 2050 will be that retirement deadline. The cool thing about a target date fund is that this fund will automatically rebalance itself the closer it gets to, in this case, 2050, to become a more safer, less risky investment. Now, a 401k has benefits, of course, but if you look at a Roth IRA or a IRA, these are two accounts that you can set up outside of just having a 401k. There is a lower limit to opening up a Roth IRA or a IRA account, but when you open these, you can invest in whatever you want to invest. You're not limited to specific mutual funds or target date funds. You can start investing in individual stocks. When you look at a Roth IRA and compare it to an IRA, there's two different things that you need to think about. With an IRA, you will not pay taxes upfront when you invest your money. But when you're at that retirement age and you pull your money out of your IRA, you will pay taxes at that moment. With a Roth IRA, you pay taxes upfront, but your money grows tax-free in your account. And then when you hit that retirement age and you take your money out, you will not have to pay any taxes. And then one account that you also need to think about and know about is the regular brokerage account. This is an account that you can always set up. So you don't need to have a 401k. You don't need to pay attention to your Roth IRA or your IRA account. You can always set up your brokerage account. Your brokerage account gives you access also to invest in everything you want to invest in. Always keep in mind and pay attention to any of the fees or taxes that you will be hit with if you take out money out of any of these accounts. So for example, let's say with a 401k, you are not supposed to take out money out of your 401k until you hit that retirement age. There are some exceptions though. You can take out money if you're a first-time home buyer and you will not get penalized for that. But if you just, for the heck of it, take out money out of your 401k, you will have to pay taxes on that money and you will get penalized for it. So as always, keep an eye on any of the fees that you might get hit with. Now, this is what you need to do when the stock market is crashing. Now, first of all, you need to mentally prepare yourself that the stock market crashing is something that will happen. The stock market has crashed before in the past numerous times, and it will happen again. So mentally preparing yourself that this can happen at any time, that's the first thing that you need to do. Second thing is, if you are an investor who is close to retirement age, your investments don't need to be in high risk, high volatile stocks anyway. Your investments need to be in safe, fixed income assets such as cash, money market accounts, bonds, annuities. And when you look at your asset allocation, maybe a small percentage can be in those high volatile stocks. Now, a stock market crash is when the stock market sees a swift and brutal decline in many different industries and sectors. Now, a stock market crash should not be confused with a stock market correction. which is when the stock market has been overvalued and it needs to be corrected. Stock market corrections happen numerous times, all the time, and they don't take that long. Now, a stock market crash is when everything goes haywire. You will see people talking about it on the news. People will be selling their shares. People will sell their stocks. People will generally be in a bad mood. Now, stock market crash can also happen for many different things. The most recent one we had in 2008, or one that we had in 2008, was the housing market crash. And then the one we had in the 2000 was the dot-com crash. And as an investor, if you are investing in the stock market, one thing that comes into play is dollar cost averaging. This, especially if you're investing in a 401k, dollar cost averaging means that you're taking a specific amount of money and you're constantly investing that same amount of money over a period of time. So you're buying shares of stock when they're selling at a high price, and you're buying them when they're selling at a discount, which averages everything out. That's why it's called dollar cost averaging. If you're somebody who participates in a 401k, you are automatically dollar cost averaging. So with dollar cost averaging, you're investing through the good times and the bad times, pretty much taking emotions out of it, which will end up benefiting you in the end. Now think about it like this. While the stock market is crashing and a lot of people are selling and losing money, there are investors that see this moment as an opportunity, because you have all these high quality companies that are selling at a discount. It's like going to the store. If you're a kid, you go to a candy store and you see all the candy is like 50% to 60% off. So yes, while people are selling and losing money in a stock market crash, there are value investors and income investors that wait for these moments so they can buy the companies and the shares in these companies at a discount. And so, for example, let's say you want to buy Coca-Cola. Coca-Cola is, for example, trading regularly. They trade $50 a share, and you have $500 to spend. So that means you can buy 10 shares in Coke. But in a stock market crash, let's say it was a bad stock market crash, the stock market dipped and Coke is selling for $25. Now you can buy 20 shares. So previously at $50, you could buy only 10 shares. But now that the stock dipped down to $25, for that 500 bucks, you can buy 20 shares. This is a technique that a lot of income investors use. And me being a dividend investor myself, that's also one technique that I use. Now let's go a little bit deeper into dividend investing. But let me talk about the capital gains and then I'll tie it into dividend investing. So another example, bought stock in Coke at $50 and I bought 100 shares. So my investment is worth $5,000. After a couple of days, the Coke stock, the price of Coke, it got up to $60. So now my investment of 100 shares is worth $6,000. I'm happy, awesome. I ended up selling at $6,000, so I made a quick $1,000 profit. I might have to pay taxes on it depending on which investment account I was investing in. So that $1,000 is going to be my realized capital gain. Now, the reverse might also happen. So I might buy Coke at $50, 100 shares. My investment is worth $5,000. But then after a couple of days, the stock price of Coke dips down to $45. Now my $5,000 investment is only worth $4,500. I panic, I sell at a loss, so I'm $500 at a loss. This is my capital loss, my realized capital loss. Now, let's say going into dividend investing, let's say I bought those 100 shares at $50. Coke pays about 41 cents every quarter in dividend income. 1 quarter times 4, 1 year is 164. I bought 100 shares. So when it comes to income, I make $164 in income with those 100 shares per year. Because think about it, that 41 cents per quarter is for one share. So times 4 is 164 for one share, but I have 100 shares. So I would make $164 just for holding the Coke stock in my account. And that dividend income gets deposited into my brokerage account. I can then decide what to do with it. I might take it out and spend it to buy whatever I want to buy. Maybe I want to buy underwear, I can buy underwear. Or I can take that income and reinvest it back into buying more shares and even fractional shares in Coke. Or I can take that dividend income and I can purchase other shares. That's the way I invest. That's the way I like to invest. And also, Coke doesn't keep their dividend price at 41 cents a quarter. They also increase it based on how they performed. They usually increase it by 5 to 10% per year. And then also, I like to invest more of my money into buying those dividend paying companies, especially in times of economic turmoil. Or I should say, my money actually goes longer, because instead of buying 100 shares at $50 if I have $5,000 to spend, I can buy 200 shares if Coke dipped down to $25. So 200 shares would give me not $164 in income, in dividend income. It would actually give me $328 in dividend income. Now, for example, here are 4 companies that pay a dividend. You got Nike, Pepsi, McDonald's, Coca-Cola, and I'll give you one more, Realty Income. They pay a monthly dividend. So most companies in the US pay a quarterly dividend every 3 months, but Realty Income is a company that pays a real estate investment trust. They pay a monthly dividend. So whenever you're reading a news article about the stock market, or you might be watching the news, the newscaster might say something like, the stock market was down X amount of points. So for example, they might say the S&P 500 or the Dow Jones was down 200 points. 1 point is $1. So when they say 200 points, they mean the stock market was down $200. Now, that in itself doesn't tell me too much, because the stock market always goes up and down. One thing that I like to do is I like to put it in perspective by looking at a larger time frame. One thing that I do, of course, is to come to this website, Financial Visualizations, finfis.com, and if you click on Futures, and then you click on the S&P 500. Now the S&P 500, of course, consists of the 500 largest companies in the US. It's a great way to track what the economy is doing overall. Let me increase the date range to the maximum. So looking at a larger time frame and not just looking at it day by day, because of course the market is always going to swing up and down. You can see that, of course, in 2000 we had the dot-com bubble crash, and then we had the housing market crash in 2008. So just quickly looking at the chart, you can see in the 2000s the S&P 500 was trading at its highest almost at 1600 points, and then it dropped down all the way down to a little under 800 points, $800. And then we've been able to recover, but then in 2008 the housing market crash. Looking at how the S&P 500 was trading, you can see that it was almost close to 1600 points again, but then it crashed all the way down to almost to 600 points this time. But ever since then we've been able to pick up, and the stock market did extremely well. There has been some turbulence, but comparing it to 2000 and 2008, we've increased tremendously. So definitely come to this website. This website gets updated frequently, so it's always going to have the up-to-date information. Of course, you can also log into your brokerage account and do some technical analysis to get all this data. But if you do not want to log into your brokerage account, or if you don't have one, you can always come to this website and just see how the S&P 500 is trending. So dividend stocks versus growth stocks. Now, when it comes to dividend paying stocks, I also call those income stocks. These are stocks that are a lot more stable when you look at their price fluctuations on the stock market. And of course, a dividend paying stock pays you as a shareholder an income on a frequent basis. Usually in the US, it's quarterly. Some examples are, of course, McDonald's, Johnson & Johnson, Procter & Gamble, even Walmart. Now, growth stocks are stocks that are a lot more volatile when you look at their performance on the market, but the underlying companies focus on growth. So all the revenue that these companies generate is put back into the company in order to grow the company as fast as possible. Some examples are going to be your Teslas, Google, Facebook, Twitter. So which one is better, dividend paying stocks or growth stocks? Me personally, I prefer dividend paying stocks, but there are no rules that say that you can only have one or the other. You can have both in your portfolio. So if you're an investor and you're thinking about it, which one should I get? Get both. So if you're not the type of person who likes to look and pick and choose individual stocks, you can always look into mutual funds and even index funds or ETFs. That's what I would recommend. So one site that you can go to, and you can also do this on Yahoo Finance, but I like to use Morningstar. Let's say there is a particular mutual fund or index fund that you want to analyze. You can type in the ticker symbol in here. I'm just going to type in the one that I invested in, which is the Vanguard 500. And on Morningstar, you will be able to see some pretty cool things. If you plug in the ticker symbol, first thing you will see is the rating that Morningstar gives it. I don't necessarily know how accurate this is or how good this is, so I usually just skip this. It's fun to look at, but okay. So what I do pay attention to is the expense ratio, so how much I would have to pay in expenses, and the minimal or the minimum investment, which for the Vanguard 500 which is $3,000, of course. And another thing, just going and looking at each individual tab, when you look at performance, of course the S&P 500 index fund tracks the S&P 500, so it should be pretty spot on. It mirrors it. So this is something that I always pay attention to. If the mutual fund or the index fund that you are planning on buying, is it performing better or worse than the benchmark? When it comes to risk, so you can see the beta that we talked to, and since this is an index fund for the S&P 500, the beta is going to be the benchmark, which is 1. Let's look at price. So interesting thing about when you go to the price tab is that you can see other fees associated with this index fund. So now if you plugged in a mutual fund, you might see some additional fees in this section and some taxes also. So got portfolio. So portfolio is also interesting because portfolio shows you the different asset classes, and you can see that with the Vanguard 500, about 99% of it is invested in US companies, which is something that I of course already know because the S&P 500 consists of the biggest 500 companies in the US. And then one cool thing is you can also see which companies you are actually investing in. Now you won't see all of them, but you will see that Apple takes up most of the weight when you invest in this particular index fund. But if you really want to know about this particular one, just look for the S&P 500 companies. And then it's also good to look at the people because you can see the management team, and if you click on a person's name, you can see how long they've been in the business, how long they've been managing investment accounts or investment funds and which ones they've actually been managing or are currently managing. So for example, let's say you looked at a mutual fund and you saw somebody that manages this mutual fund, but they've only been on the scene for like a year or 2 years. You might not have that much confidence in them, so you might want to skip that mutual fund and look for a fund that has a team member that has been investing for a longer time. So as I stated earlier, I started out by buying an index fund, which was the S&P 500 from Vanguard. After I bought my first index fund and I got familiar with kind of how the stock market worked, that's when I started learning and teaching myself about fundamental analysis, which allowed me to pick and choose individual stocks which work best for my investment account. And after I taught myself about fundamental analysis, I noticed one thing. I noticed that whenever I would buy a stock, immediately the stock would go down in price. I'm like, this is something that I did not like, so that's when I started looking into day trading. And I do use some of the day trading techniques, especially when I'm buying stocks. These are topics that I will discuss on a different time, on a different day. So I hope you enjoyed this topic today about stock market investing for beginners. Let me know what you thought about it. Let me know if you got motivated to start investing, and I'll catch you guys in the next one.